Hello, good morning, friends. Now we'll discuss the remaining part of your syllabus, Unit 4, Non-Banking Financial Companies, Lecture 2, discussion points on regulations of non-banking financial companies, microfinance, its meaning and features in this lecture series. In our previous class, we have already seen the meaning of the non-banking financial companies, what are the different types of non-banking financial companies and role of the non-financial banking companies in the country. Now we will understand the last part of this non-banking financial company discussion is the regulations of non-banking financial companies, how these non-banking financial companies are regulated. After that, we will discuss the additional part of the non-banking financial corporations in the micro level, that is called microfinance, because non-banking financial corporations play a pivotal role in micro level also. Therefore, we need to understand this microfinance, what is it microfinance and all. Now, coming to the point of controlling of non-banking financial corporations, it is a unique kind of a controlling style we have in our country, because the banking companies are totally controlled by the Reserve Bank of India, whereas non-banking financial corporations are not only controlled by Reserve Bank of India, but they are also controlled by the Companies Act of 1956 or 2013 amended Companies Act. So therefore, in the establishment and all that, non-banking financial companies have to follow the compulsion rules of the Companies Act of 1956. But when it comes to the operations of the non-banking activities, because they are also taking part in some portion of part in the non-banking activity, then Reserve Bank of India lays down lot of what you call as rules and regulations. Therefore, they must and should follow these rules and regulations. Now, let us understand what kind of rules and regulations are applicable for operations of the non-banking financial corporations in our country. If you see, the first important part is in terms of Section 45 1A of the Reserve Bank of India Act of 1934. It puts a mandation, the compulsion that every non-banking financial company should be registered with the Reserve Bank of India. Without the registration with the Reserve Bank of India, these non-banking financial companies cannot operate. So the commencement or to carry on any business of non-banking financial institution, Reserve Bank of India registration is must. But the Reserve Bank of India gives a registration not under the scheduled or non-scheduled list of the banks, but it gives as a non-banking financial institution registration. So it is separately governed by Section 45 1A of Reserve Bank of India Act of 1934. However, to obviate dual regulation, certain categories of non-banking financial companies which are regulated by the other regulations are exempted from the requirement of registration with the Reserve Bank of India. Dedicatedly venture capital and fund merchant banking companies, stock broking companies registered with SEBI. Now, there are certain kinds of non-banking financial companies which are totally come under the Securities Exchange Board of India. These non-banking financial companies need not require to get registration with the Reserve Bank of India because they fully come under the control of SEBI. Those non-banking financial companies which are not engaged in share market business or in secondary market activities, but they are only engaged in providing the financial assistance to the public or to the industry, such companies must and should get registered with Reserve Bank of India. The non-banking financial companies which are exempted from Reserve Bank of India registration uh, are venture capital and venture capital fund, merchant banking, and companies, stock broking companies registered with SEBI. They need not require to go for any kinds of registration with the Reserve Bank of India because they fully follow the SEBI rules. But other than these three companies, these three types of non-banking financial companies, every non-banking financial company should register with the Reserve Bank of India. And for the registration purpose, there are certain kinds of compulsions laid down by the Reserve Bank of India. The minimum net owned fund of any non-banking financial company which registers with the Reserve Bank of India should have at least 25 lakhs. But it has been raised to 200 lakhs, that is 2 crores, with effect from April 21, 1999. See, any non-banking financial company which undertakes the business of banking, non-banking activity should have a net worth fund. That is the minimum net owned fund, means capital, paid up available capital should be 2 crores in order to operate in the area. Next one is the non-banking financial company should have minimum 10 to 15% of their deposits in liquid assets effectively from January 1st and April 1, 1998 respectively. It means that 10 and 15%, they have to maintain 10 and 15% of their deposits in the liquid assets. Means that if at all the non-banking financial companies are allowed to accept the deposits, because non-banking financial, especially residuary non-banking financial organizations, are allowed to accept the deposits, but these deposits are not similar to the banking account deposits like receivables in terms of deposits like savings bank account and current account. These non-banking financial corporations cannot attract savings bank and current accounts, and does not operate these accounts through checks. That is the compulsion kept in the by the Reserve Bank of India. But if at all any non-banking financial company is accepting the public deposit should maintain 15 and 10 and 15% of their deposits in liquid assets, 10 to 15% in the liquid assets, because whenever the investor in the deposits asks for the money, they should be able to provide these deposits back to the investors. That is why this compulsion has been kept. So they have to maintain 10 to 15% of the liquid deposits. Then the fourth important one is all non-banking financial corporations are not entitled to accept public deposits. Only those non-banking financial companies holding a valid certificate of registration with authorization to accept public deposits can accept or hold a public deposits. It means that all non-banking financial companies are not allowed to accept deposits. If at all any non-banking financial company wants to hold the deposits as a source of finance for their business activities, they should take a special permission from the Reserve Bank of India. And once they take the special permissions, they have to compulsorily follow the rules of liquid cash maintenance. Then the fifth one is the non-banking financial companies have to create a reserve fund and transfer not less than 20% of their net deposits to it every year. It means that the reserve fund must be compulsorily maintained. What is a reserve fund? Reserve fund is the amount which is kept available with the non-banking financial company only, which cannot be used for any other purposes other than the purpose of liquidity. So reserve fund is the fund which is appropriated from the profit, which is taken out from the profit, and that much of percentage of the reserve fund has to be maintained. And every year it has to transfer not less than 20% of their net deposits to it every year. It means that if 1 lakh rupees deposit is collected this year, 20% of that should be kept in the reserve fund, and that reserve fund must be shown in the balance sheet every year. And while editing the balance sheet, the Reserve Bank of India will ask whether 20% of the net deposits are kept in that particular year or not. So reserve fund has to be compulsorily maintained with themselves. They did not require to transfer it to Reserve Bank of India. It has to be maintained because it is a liquidity kind of a arrangement. The sixth important one is the non-banking financial companies are allowed to accept, renew public deposits for a minimum period of 12 months and maximum period of 60 months. They cannot accept deposit repayable on demand. Remember, there are these are very important conditions that have been laid down. The non-banking companies, if they are allowed to accept the deposit, they can accept the deposit for a minimum period of 12 months. It means that 1 year. They can accept the deposits minimum of 12 years, maximum of 5 years. They cannot take a longer deposits more than 5 years or lesser deposits less than 1 year. So that is the compulsion. Because of that, the RD accounts and all kinds of accounts which are maintained by postal departments and all that nowadays is minimum 12 months and maximum of 5 years. Within 12 months, if at all the deposit is to be withdrawn, the deposit holder, the person who keeps the deposit with non-banking corporations have to compulsorily pay the penalty for withdrawals, for penalty for withdrawals. They cannot withdraw the money within 12 months. But in case of any banking industry, if at all deposit holders keep the money, the next very day he can withdraw the money. There are no any exit charges on the deposits. Whereas in case of non-banking financial corporations, if at all the deposit holder wants to withdraw the money before 12 months, he is charged with the exit load. That is what we call as the charges on maintenance, and this is a penalty which is levied out. And any deposit more than 60 months is not allowed. He has to have a fresh deposits contract with the non-banking financial company. So these are the compulsion restrictions. Next one is non-banking financial companies cannot offer interest rates higher than the ceiling rate. Yes. Any deposit interest that they are going to pay should not be more than the ceiling rate which is mentioned by the Reserve Bank of India. It means that indirectly they should not compete with the banking sector. They can charge nowadays. The recent one is maximum of 11% per annum on the total deposits that they receive. Right? Offer the interest on deposits. Next one is they have to obtain a minimum credit rating from any one of the three credit rating agencies. We have credit rating agencies. Credit rating agencies are the independent institutions which analyzes the credit ability of any company and certifies them with a certificate called A level, B, A level, A double plus, like that. So these kind of rating has to be made. There are basically some of the certified credit rating agencies in our country, like we have CRISIL, we have Creta, like that. These companies must certify. The non-banking financial company should get the certificate of credit worthiness from any one of the uh, um, credit rating agencies. Then next one is non-banking financial companies cannot offer gifts, incentives, or any other additional benefit to the deposit holders. In order to attract the deposit holders, they cannot offer gifts or any kinds of attractive things to the deposit holders and create the marketing or advertisement charges like that. They are not allowed if at all they are registered under Reserve Bank of India. So these are the various conditions which have been levied by the Reserve Bank of India to regulate the non-banking financial corporations which accept the deposits. But any non-banking financial companies which does not accept the deposits will directly come under the control of SEBI and Companies Act of 1956. So automatically they have to undergo with those kinds of regulations. So this is regarding the regulating framework of non-banking financial companies. I will go move to the next discussion point, which is most essential from the point of your view of your discussion is microfinance. So nowadays, what happened, the microfinance is most essential because below poverty line population or the people who are deprived of financial benefits, who needs the financial assistance, whose needs are to be satisfied compulsorily. Therefore, the government of India has floated a concept called microfinance activities. Most of the non-banking financial corporations adopt this microfinancing and help the needy people who are below the uh, poverty line. So microfinance means at a micro level, at a small level, small amount of financial assistance is given to the public for transforming their life. For example, for any small artisan who wants to start a pottery business, wants to start a weaving business at a very small level in the village area, who needs a very small amount of investments, like maximum of 5 to 10,000 rupees, or to less than 1 lakh rupees investment he expects. So, and the tenure is also very less, within 1 to 5 years. This microfinance may not be for a long term also, because within that time he picks up his business and repays the loan back. But to start up the things, he needs a small amount of money to be invested. Therefore, to assist such kind of a people at the micro level with a micro amount, small amount, the microfinancing concept has been implemented. And this microfinancing activity is largely today applied by even non-banking, banking and non-banking organizations. Both are working. But if you see the level of non-banking financial organizations involvement in providing microfinance is found to be more. Therefore, now we will discuss what the microfinance is and features of the microfinance. Microfinance is defined as any activity that includes the provision of financial services such as credit, savings, and insurance to low income individuals which fall just above the nationally defined poverty line, and poor individuals which fall below the poverty line, with the goal of creating a social value. It means that microfinancing is not only what I call as giving loans advances, even pooling the investment, small amount of investments from the low class population in the form of savings or in the form of insurance businesses, providing them little amount of insurance for their um, risks, that can also be undertaken by these institutions. So therefore, credit, savings, and insurance are the three different kinds of services provided at the lower level, that is called microfinancing activity. But largely, microfinance refers to credit provision to the needy people. Who are the beneficiaries of this microfinance? They are the people who are either just above the nationally defined poverty line or just below the poverty line. So the poverty line is defined by the government of India every year through certain statistical analysis. Poverty line refers to a minimum amount of income that is required to hold the life. That line, that minimum income is called as a level of poverty. Any person below that level is considered to be below poverty line. Any person who is just above is called as above poverty line. So poverty line, in the sense, the minimum least income that needs to hold a family to survive, that is level of poor level of performance. So any person who falls in these category are assisted through microfinancing. Microfinancing. The creation of social value includes poverty elimination. Why this microfinancing creation is done? Because to eradicate the poverty and the broader impact of improving livelihood and livelihood opportunities through the provision of capital for micro enterprise and insurance and savings for the risk mitigation and consumption smoothing. These kind of services are provided to the people who are below the poverty line area, just to improve their quality of life, just to increase their ability of earning. These microfinancing services are provided. So the government of India is motivating large number of non-banking financial corporations to come out with the microfinancing activities to help the needy people. So if you see the features of microfinance, microfinance, it is a tool for empowerment of the poorest. The main objective of this microfinancing is a tool for empowerment of the poor people. So the loans and advances are provided to them at a very lower level, and the amount of loan is also very small, not so big. It is maybe within 1 lakh. And not only this credit facilities provided to them, even the insurance facilities, small insurance and saving habits is also increased among them. It is essentially for promoting a self-employment, generally used for generally used for in order to promote the self-employment among the women, among the needy people in the village area. This microfinancing is being implemented. So the self-employment which is developed there in the village area, the microfinance organizations are not only providing credit facilities, but they are also providing the knowledge, training to the lower people in the village areas. Even the big non-banking financial corporations like Goldman Sachs and big financial organizations are now coming up to the micro level for helping the people. Goldman Sachs conducts the training program for at least 10,000 population rural women in the village area, and after the training these financial company provides non-banking financial company provides financial assistance for establishment, like for example artisans in the village area, then the the women in the village area who are involved in certain kinds of basic pottery activities or home products production and all that, they are trained on that line. They are trained how to market the product, how to create the brand and all that, and also supported with the finance. So this is what the feature of this microfinance that you can see, providing support for generating employment opportunities in the rural area. It is a tool for empowerment of the poorest. Then delivery is normally through self-help groups. The services are delivered, microfinancial services are delivered through self-help group. Self-help group in the sense, it is a kind of cooperation that the people of particular group that they themselves go for it. So they create a help group, self-help group, and the members are given financial assistance from the non-banking financial corporations, because the self-help groups are adopted by these non-banking financial companies, and they are provided with all the uh, support of credit and knowledge and training to these people. For example, in village area, women can have a self-help group, that all the women who are working, who are working in the farm areas, they can develop the self-help group and involve any one of the uh, entrepreneurial activities. For that, they can apply to any of the non-banking financial corporations. Such non-banking financial corporations will adopt that self-help group and provide them the training, provide them the knowledge and technology, and also provide them the what you call as uh, financial support. So this is called self-help group, SHGs. Then the microfinancing is not just a financing system, but a tool to social change, especially for women. Especially for women, it acts like a tool of changing their lifestyle. Because of microcredit, it is aimed at the poorest. Microfinancing lending technology needs to mimic is to mimic it. It has to eradicate the poor kind of a situation in the village area. That is the basic objective of this. So these are the basic microfinance features. In the examination, question may be asked, what is microfinancing, and discuss the various features of the microfinance. So here we will end the lecture. Thank you. We will see the remaining aspects of microfinance, advantages, and the models of microfinance in the country. What are the various types of microfinance models in the next lecture. So I thank you for your kind cooperation in listening to the lecture, and I wish you good day. Thank you.